Hello. Today is Tuesday, March 11th in the morning, and I wanted to make a video about the economy and the stock market because obviously yesterday, most of you probably know, the stock market had a terrible day, just terrible. And some people thought, well, maybe we'll have at least a dead cat bounce today, a little rally. But so far this morning, from what I saw, it was still down more. I watch CNBC. Sometimes I watch Bloomberg. I watch other news sources. I like to keep up with what's happening in the economy, in the markets, in politics, in world events. And I hear a lot of commentary, the financial and economic commentary. Yes, we're starting to hear the R word being used. Are we entering a recession? We're hearing the S word. Could we be headed for stagflation? But I'd say most of the commentators keep trying to reassure the public. The economy is still strong. There is no sign that we're in a recession. This is maybe just a correction, just a normal bull market correction. We're still in a bull market trend. I expect the economy to strengthen this year due to deregulation and strong business incentives and tax cuts and so on. So I'm going to make the case for why we might be in recession right now, what the argument is. And this is not to be construed in any sense as financial advice. I'm not giving financial advice, but I think a lot of people are wondering where the economy is headed, where the stock market and the bond market and other markets are heading. And I'm just going to give my opinion based on my knowledge and my views. By the way, I have a little note card to try to keep track of the main points. Pink card, like a pink slip, like when you get fired. That's my notes there. Uh, so what is a recession? Well, there's different definitions, some of them fairly technical, but let's use the simplest definition of all for the purpose of this video, and that is that a recession is two consecutive quarters, that is, two consecutive 3-month periods of a decline in gross domestic product, GDP, the total production and consumption of goods and services in a country. And I'm talking here about the United States since that's where I am. Well, the Atlanta Fed just recently, in the last week or so, put out an updated projection for this quarter, the January, February, March 2025. At the beginning of this quarter, they were projecting an annualized 3% growth in GDP in the United States. Now they've dramatically revised that down to apparently over 2% decline on an annual basis in this quarter. We'll see if they're right or not. The quarter's not finished yet. We're in sort of mid-March right now. And the initial figures won't come out till April, but Atlanta Fed is already calling for a down quarter. We get one more quarter of that, by one definition, we're in recession. And that's a problem with the recession. Official agencies don't declare it until you've already been in it for 6 months. And, if you're trying to decide what to do, that's kind of like driving by only looking in the rearview mirror. We'd like to have some degree of predictability of where we're probably headed. All right, so Atlanta Fed says we're already negative now. Let's talk about the roles other things are playing and why we may be in a recession now or likely will be this year. Inflation, remember that word? Yeah, it was up to 9%. That was the official figure. 9%, what, 20, 23, I think. Then the Federal Reserve started rapidly raising interest rates to curb inflation. Said, oh, we're trying for a soft landing. We're trying to slow down the economy, slow down inflation without a recession. Then they started saying, yeah, well, we've achieved soft landing. Well, inflation never got down to their target of 2%. It got down into the twos, but in the last 3 months, it started going up again. And I see a lot of indications for why it may go up further. So we didn't conquer inflation. And with inflation, a lot of people are having more and more difficulty just living, just finding the money to pay the rent, to pay the mortgage, to make the car payment, to buy groceries. You've seen what food prices have done in the past year. So inflation is hurting the purchasing power of a large segment of the U.S. population. The upper 10% are doing great. The lower 90% are not doing so great. I just recently heard a survey that said in the lower 1/3 of the U.S. population by income, I think 55% said they're worse off than they were 5 years ago. In the top third, 65% said they're better off than they were 5 years ago. So income inequality is widening, and regular consumers are finding it tough just to get by. Delinquencies on car payments, on mortgages, on credit card payments are beginning to rise. That can be an early sign of going into recession. A lower US dollar. This is one stated goal of the current U.S. administration. They want to see the U.S. dollar come down. Why? Because the president is extremely concerned about the fact that for years the United States has had a trade deficit with other countries. That is, we buy more foreign goods than we do selling our goods to foreigners. And he feels that's a sign of U.S. weakness and that we've got to have at least a neutral, if not a positive trade balance. And one way to reduce the trade deficit is to weaken the dollar, because a weaker dollar means American goods become cheaper to buy in other countries whose currencies are relatively strengthened by our weakening, and it becomes harder for us to buy foreign goods because they're more expensive. So just recently, the dollar, which had been very strong, is starting to soften. He wants to see lower interest rates. Why? Well, because this is a real problem, because the U.S. has a huge budget deficit. And when interest rates are higher, it becomes harder and harder for the U.S. government to just make the interest payments on the debt. But does Trump plan to lower the U.S. deficit? Not at all. If he has his way, it looks like the deficit will balloon out even bigger. But anyhow, the dollar is starting to soften, which means imported goods become more expensive. That leads to inflation in the U.S. Will the trend continue? We'll see. We don't know. Leads to the next item, tariffs. This is a biggie. When the new administration took office, and this isn't meant to be a political commentary, it's a commentary about the economy and also the market. But government decisions are clearly affecting the economy. So initially, the president said he was going to impose 25% tariffs on everything coming in from Canada and Mexico, and an additional 10% tariff on Chinese goods, which already had some tariffs on them. And then he said, well, I'm going to pause that until March to give some time for negotiation. And he said this was all because of drugs coming into the country, but that can't be the real reason, because Actually, hardly any drugs are coming into the country from Canada. It's really about the trade deficits he doesn't like, and he wants to reduce the trade deficit. And then he said, "Oh, well, and I'm going to delay it until August 2nd. I mean, till April 2nd, which is only a couple of weeks away." But he's still talking 25% tariffs on everything from Mexico and China, two of our largest trade partners. First, he said an additional 10% on China. Now he says another 10% on top of that. So, additional 20% tariff on Chinese goods. And he says he's going to add tariffs on steel and aluminum from everybody, including Europe. I mean, from all foreign steel and aluminum, 25% tariff. And now he's just announced, oh, but for Canada, it's going to be a 50% tariff on steel and aluminum. And then he says he's going to add tariffs on imported computer chips, which affect cell phones, cars, personal computers, laptops, iPads. Heck, they affect everything anymore. Even your microwave, your refrigerator, everything has a computer chip in it. So tariffs raise the cost to the American consumer of imported goods, and we do import a lot of goods as well as exporting a lot of things. Foreign countries are going to add their retaliatory tariffs on the United States, trying to convince us to back off. And then Trump's announced that if they tariff us, he'll double tariff them. He'll retaliate. This is a trade war. Trade wars hurt everybody. They hurt everybody's economy. They can easily throw the entire world into a recession, if not worse. And even if no tariffs actually come into effect, which seems unlikely, the administration seems determined to put on some tariffs, and other countries are going to retaliate. But imagine they all go away. The problem is it's already hurting our economy right now. Businesses, both large businesses and small businesses, are afraid to invest anything because they don't know what the cost of the goods they need to make stuff or to resell at retail. They don't know what the costs are going to be. They don't know if their supply chains are going to still be available. They don't know how much they will or will not be able to sell overseas. They have no idea what the business environment is going to be like next month or next week, let alone 6 months from now or 2 years from now after they build a factory. They don't know if it's going to be profitable or not. So business investment has almost come to a standstill. Business hiring is pretty much dead. Businesses are starting now to lay people off. Layoffs and unemployment is a lagging indicator. By the time you see unemployment significantly rising, you're likely already in a recession. Firms try to hold on to the workers they already have. Why? Because it's expensive to hire a worker, and it's expensive to train a worker. And if you lay somebody off just because your business is slow for a little while, what if 4 months from now you need them back? They may not be available anymore. They may have found another job somewhere. Now you have to look for somebody else and train them all over again. So the last thing that businesses do when they're hurting is lay people off. They try all the other cost-cutting measures they can before a layoff. Some unemployment figures for last month came out, but they're really too early to capture what's actually happening. We will see the unemployment rising more over the next several months. You've heard that, I don't know, tens of thousands of federal workers have already been laid off, and that the government wants to lay off many tens of thousands more, at least 60,000, maybe 100,000 or more. that's a big blow to the economy, especially if you have an economy that's already slowing, which ours is. It used to be that the federal spending would help prop it up and avoid falling into a recession. But now, on top of an already slowing economy, we have the federal government cutting spending and laying people off by the tens of thousands. It's a very poor sign for future economic developments this year. Consumer sentiment is terrible. The latest consumer sentiment figures are a distinct drop. Why is that important? Because consumer spending amounts to 70% of our GDP. When consumers become pessimistic and start delaying expenses, it's easy to fall into a recession. The other 30% is mostly business spending, which is also shrinking, and government spending, which is also shrinking. And so consumer sentiment is down. The uninversion of credit spreads. Some of you know what I'm talking about. Others maybe have no idea what I'm talking about, but it's in the bond market. Normally, you see the longer the duration of a treasury bond, the higher the yield somebody wants to buy the bond. Think about your friend or your relative, Harry, asking you, can I borrow $10,000 and I'll pay you back in 3 months? Or he says, can I borrow 10,000? I'll pay you back in 30 years or over 30 years. Which way would you want to charge him more? Well, of course, you want to charge him a higher rate if he says it's going to take 30 years for you to get your money back. You don't know if he'll be alive. You don't know if he'll still have a job. You don't know if he'll ever pay you back. 3 months doesn't sound so bad. So normally, the longer the duration on a loan, including treasury bills, notes, and bonds, because they're basically you lending the government money, the higher the interest rate. An inverted rate means short-term rates are higher than longer-term rates. Abnormal situation. We've had that for, I think it was almost 2 years. It finally uninverted a few months ago. You think that's good. Actually, that's another bad indicator, because a recession, historically, recessions most of the time follow the uninversion by anywhere between 6 to 18 months after an inverted yield curve uninverts. The yield curve uninverted. Now we're waiting for the shoe to drop. Delinquencies, I mentioned, delinquencies on car loans, delinquencies on credit cards, they've been rising. Not to a catastrophic level yet, but those are another early indicator that the economy is turning down. The housing market. The housing market is dead. I mean, the housing market is terrible. People cannot afford to buy homes, and a lot of people can't afford to sell their home, because if it's not paid off, maybe they have it at a 4% mortgage rate, and to buy another home, it's going to be a 7% rate. They can't afford to sell. People can't afford to buy. Housing market is one significant part of the U.S. economy. So there's about, 7 or 8 reasons why we may already be in a recession that won't be called for another 4 months or so. And even though we may get a dead cat bounce pretty soon, a little rise in the stock market that took such a beating yesterday, I see more personally, I see more downside risks ahead. So yes, I think either we're in a recession or we're going to be in a recession this year. Sorry for the bad news, but sometimes it's nice to just face the facts. I think I forgot to mention how overvalued the stock market was. before the last couple of months. Valuations were so high, the US stock market was priced for perfection. If anything went wrong, the market was going to drop. Right now, a bunch of things are actually going wrong. Thank you. And now if I could get my video back, I could stop this.